to another edition of our series, COVID-19, From Crisis to Creation, here on Mentored TV. I'm your host, Patricia Falco Beccalli. Well, today we're going to look at a sector that is very dear to my heart. We're going to look at the investment and startup sector. I'm a business angel myself, so I'm looking at the impact of what this crisis so far has had on startups, but also on the funding scene. We're going to specifically also look at the venture capital market. How is it doing here in Europe compared to the US? What is the impact? What is the outlook? What are people doing in order to get over this crisis and create the future? And we're also going to look at the questions such as value creation, and valuation of companies, as well as the relationship between investors and the startup founders, entrepreneurs. In order to do all of that, I'm today joined by Kevin Reeder. He is the head of a venture capital fund. Kevin, thank you very much for being with us. And let me quickly also update the people who you really are and who you represent this morning.
Sure. Thank you, Patricia, for having me. So I'm the CEO of BMT. We're one of the state-backed, what's so-called Länderbeteiligungsgesellschaften in Germany, means state-backed venture capital firm, probably a concept that's more applicable here in Europe than the US, but we can talk about that as well. We're a 100% daughter company of the Turing Development Bank, so we have an interesting mandate that combines venture capital investing along with economic development of the region.
Well, this is, I think, very impressive, and I think you manage more than 400 million euros. Apart from that, you're really kind of, a special person because you're American-born. Most of the time, you work in the US, in Europe as well. Now you're in Thüringen, in Thuringia, overseeing portfolio companies in your funds, and also you've always been in investment management. On the other side, you've also experienced what it is like to support a startup a few years ago back in Africa, a solar energy company, and you were there watching it go from a 5 million euros worth of a turnover, I think, to over 60 million right now. So you can really give us a really in-depth insight what it is like as an investor, as a venture capitalist, as well as from perhaps a startup founder's point of view, what is going on right now. So why don't we start with that, Kevin? Why don't we just have a look at robbing around the globe? What is venture capital, and what is it like in the US, for example, compared to the US?
Okay, yeah. Well, venture capital essentially is the early stage funding of companies that have an idea they want to bring onto the market. And usually those companies, of course, are not cash flow positive early on, so they need equity financing and are not able to get any kind of bank debt. So that's the role of venture funding, to early stage funding and using equity. It can take many complex terms and conditions. That sounds very simple. It gets a lot more intricate than that when it's finally finalized. But maybe I'll just give you a little bit, venture capital investing essentially started in the US, I'd say kind of 70s, 80s, 90s was kind of taking shape. Because of that, it has a lot longer history than the European venture funds. And that actually becomes kind of important when you're now analyzing how are things reacting now with COVID-19, things like that. But, a lot of the well-known US venture funds, Kleiner Perkins, Sequoia, Khosla, they've been around for decades. And that means they've gone through many fund generations. They also have extremely large pools of capital, which gives them the ability to pursue different kinds of business models than smaller funds would be able to. European scene is younger. I think most of the certainly in Germany, I can speak better to the German scene than the overall European scene. But in Germany, really kind of late 90s, early 2000s is where the first venture funds that were truly making impact in innovation in the German landscape came to be. And then you had, the Neue Markt, the NASDAQ collapse, Neue Markt here in German. Then you had the 2008 and 9 financial crisis, and now here we are facing another crisis. But it's been a pretty rocky road for the European venture community since its start. It still has, I think, become a really integral part of driving innovation in Europe. And we can get into what types of businesses are better financed there versus here. But that kind of gives you the overview of the differences.
Yeah, I think what is interesting to mention also, the reputation of private equity companies, venture capital funds is sometimes a little bit murky, but
Yeah.
it must not necessarily be like that
Right.
in terms of, really participating into a company, not only because you kind of spray, hope, and pray with your money that the companies will become some unicorns once upon a time, but really to create value. What do you think does actually happen in Europe compared to the US, for example?
Yeah, well, actually, I would give both industries in the U.S. and Europe a lot of credit. The venture industry, I think, is definitely not the locust or the Heuschrecken, it's called in Germany, trying to take advantage of companies. I think venture is such an early stage, high risk phase of investment that you're only going to succeed if the overall venture is successful. When you're talking about private equity and established companies, those companies have so much substance that you can kind of make money by financial engineering tactics and reselling. You can kind of play sometimes a greater fool game with those kind of companies. And there are investors that specialize in that activity. And I think they maybe rightfully so have a reputation of not really adding value to society, but rather extracting value from pre-existing companies and models that are there that already have achieved a lot in the business. They still have a role to play, and you need to have an activist approach. Otherwise, you have sometimes management teams that are no longer true to the company or to their other stakeholders. It is good to have that element there to hold people in line and companies in line, some kind of checks and balances. But on the venture stage, let's focus on the early stage, which is really where the bulk of what I would call venture capital is taking place. There, I really don't see a lot of kind of value extraction. Everyone's focused on creating value. And it kind of leads me to an interesting point about the differences between the U.S. and the European industries. Now, those are overgeneralizations. Europe will have some companies that are kind of like the U.S. companies. The U.S. will have a lot of companies that are like these. But I like to view it in two buckets. You've got value creation and value capture. And if you want to have a successful investment return, a company is going to have to execute well on both of those. They're going to have to create a lot of value, and they're going to have to capture that. In the U.S.,
sorry to interrupt, that means to exit well.
Well, it does not necessarily. That's the investor view of capturing. That from a company standpoint of capturing, it means to create good margins and cash flows out of your successful business that you've created. There's the value creation for the investor is not always one-to-one in terms of timing with the value creation and capture of the company, because the exit is then for the investor, and usually the company will continue to go. Sometimes it's just a change of ownership, or it'll take a strategic buyer. That company will still exist. It might have a different name, but essentially those people are going to be driving value the way they were before. So I was talking more at the company level. And I think, venture capital is such a long-term relationship, because you're getting an early stage. Venture investors have to be committed to be investing with companies, not investing in stocks or investing in companies like you often see with publicly traded investors or even the later stage private equity, as we discussed just now. So you got a long-term commitment, but you also have to be aware of what your ecosystem allows. And what we see a lot right now is kind of in Europe, people bemoaning, why don't we have the global champions, the Facebooks, the Amazons, the Airbnbs, the Ubers that the U.S. has produced, or the WeChats in China, Alibaba, Alipay, all these things. And I think it's interesting that to pursue these kind of value creation models, you need to have both. You need to create value and capture it, but you don't have to do it in any particular order, in my view. Now, the U.S. has become well known for this model of really expanding quickly, these global platforms where they create a lot of customer value, and then they plan to capture that value in the future. Facebook is an incredibly positive example of that working. If you remember the early days of Facebook, people would say, wow, they're getting all these users, but how are they ever going to make money on these users? And obviously that model has proven to work. You've had great advertising revenue coming in, et cetera. You look at Amazon's model, where they use the flywheel effect, essentially, where Jeff Bezos is brilliant at this, right? He says, we're going to offer low prices, which will attract a lot of customers. And then because we have scale, we can even lower prices further. And he gets this kind of virtuous flywheel going, where that's his way of finally creating that market power to capture the value that he's created. Yeah. And really these companies have created huge customer value.
Yeah, and Kevin, I really, really like that you are so super specific. Okay, we're talking about the US, we're talking about unicorns, but at the end of the day, if you look at the venture capital investments last year, I think was over 130 billion in the US compared to about 36
Yeah.
billion in Europe, not even 7 billion in Germany where you are sitting. Of course, the creation of unicorns is something that seems to be more likely simply because of the magnitude of the market.
Well,
However, let's
it's
be yeah, let's be specific because the valuation and the true intrinsic value creation through trust and partnership between investor and the founder, I think, is very important. And if you look at companies, I just pulled out a couple of them. And the latest scandal, I would say, is, for example, WeWorks.
yeah.
Right? I mean, madness,
Yep.
absolute madness. It is a great idea, I think, from a business concept point of view. How it then from a business model and the numbers would work long term, I always ask myself. However, valuation go crazy, IPO is being prepared, IPO is being the initial
Yeah.
public offering to those that are not in finance, is going really sour. And now COVID-19 hits,
Yeah.
and anything in the sharing economy, Kevin, and please correct me
Yeah.
if I'm wrong,
No.
it's just
Yeah.
going to have a really tough time long term.
Sure. Yeah. I mean, even look at Airbnb this week, what they announced had to reduce their workforce by 25%, and they were ready for an IPO probably this year, performing brilliantly, and now they're going to have 50% less sales than they had in 2019. That's what they're projecting now for 2020. So yes, you nailed it. You hit the nail right on the head because in order to pursue those kind of models, you really have to have a huge amount of funding to back that. You have to have founders with incredibly aggressive mentalities, that really. Reid Hoffman has done a really interesting series on this. His book, Blitz-Scaling, and his podcast. I highly recommend that to any startup investors or startup entrepreneurs to read
Reid
that.
Hoffman is, of course, LinkedIn.
He was the founder of LinkedIn. Yes.
Yeah.
Actually, an interesting point as well. We can get onto that about how in America, I think you more often than not you see, or more often than in Europe, you see founders not being CEOs for very long. In here, we can talk about why that's an interesting point. But let's stay on this main topic. And his main sentence in Blitzscaling is prioritize speed over efficiency in the face of uncertainty. We could unpack that a little bit because in Germany, efficiency is viewed as the absolute highest good you could possibly have. So why would you ever prioritize something over that? But in certain markets where you have to act fast and create these kind of network effects, you do need to prioritize speed. Get big before you get good. And that's the mentality behind that. But you can only do that if you have big capital. And that's where the U.S. funds and the amount of capital in private equity venture capital, as you just said, 130 billion versus 36 billion, is such a monumental difference that it's incredibly tough to pursue those kind of models here. There's other reasons as well that the U.S. is culturally well positioned. You have a lot of founders in the U.S. that are from other countries. So already when they're building their business in the U.S., they already understand multiple geographies and cultures and how to grow their businesses in those various environments. Whereas, in Europe, it's more homogeneous populations, et cetera, and sometimes it is tougher. But I don't want to sound negative on the European venture capital scene because I'm actually very positive on the European venture capital scene, and that's why I want to switch over from this model of value creation and then capture to doing it the other way. Do value capture, develop your technology, patent it, get it protected, and then create the value on top of that. So that's kind of the antithesis of Reid Hoffman's approach, which is blitzscaling. Here you have nail it, then scale it.
Yeah, and I think that is really, really important because what you have then is a solid structure in terms of the bottom line, the business itself, that then goes scaling, and scaling means to go global, to then really grow, but grow on good fundamentals. Yeah. But you said a couple of things that really struck a chord with me, Kevin. First of all, you were talking about more aggressive founders in the US rather than here. And I guess the same sort of thing is also when it comes to risk aptness amongst the investors. Yeah. And I wonder, now we can move on to a little bit the cultural differences which might make the European VC market more or less resilient to the crisis. Mm-hmm. And that is the culture amongst investors, risk aptness, as I said, amongst the founders. Oh, it is my baby. I'm not looking for an exit, an IPO, or maybe even making profits because I just love what I'm doing.
Yeah,
okay.
Yeah.
And then also what you were mentioning right now, a homogeneous market, which in Europe really only started after the European market was created, 1992, with the euro, where also fundraising possibilities changed also for the VC scene. Before that, there was not much VC investment going on simply because of the structure, I guess.
I think that's true. Yeah, that's a good point. I mean, let's say this, it's easy to be an aggressive founder when you have big capital backing you, and you have and you've had investment funds that have had success doing those kind of models. They're obviously willing to take bets on more of those kind of models because, and this is kind of a key point, that approach of blitzscaling and going big fast is a way to lose a lot of money too. It's a way to make a lot of money if it works, but it's also a way to lose a huge amount of money if it doesn't work. So I think, horses for courses, we say, understand what you can do well and invest in that. You can make great returns. Where it goes wrong is if you do the wrong thing. And, you mentioned WeWork, and WeWork was a classic example of thinking that they could go big and then capture value when they somehow reached maybe some kind of monopolistic or oligarchist.
And they had big backers. I mean, they had SoftBank behind them, and Apple. They had other private equity companies really giving them also operational support.
SoftBank has tremendously distorted the venture market in the last few years. That's a topic for another show, I think. But it is amazing what Mayoshi-san really has done for better or worse. We'll see how it plays out in the end. But it certainly was very distorting for a lot of venture investors. Not less in Europe. He did do some investments in Europe, but more he was active in the U.S. Anyway, but I think Europe will be affected less than the U.S. from this COVID crisis in the venture scene. We have less capital, but we also have models that have been less aggressive. And we're taking that approach of focus on tech a little bit more, or I think we should be. And in Turingen, we definitely are, because that's, for one thing, it's our only option. We don't have big capital to really back those other models, but we also have great engineering here. And so, when you're not planning with a huge amount of revenue over the next few years anyway, because you're focused on developing the tech that's going to be interesting in the future, falling off of revenue doesn't hurt so much, right? And as you mentioned, the B2C models, it's the sharing models, it's the travel, it's anything where we're going to come together as a group, or where the end customer was a consumer, can also be B2B2C. Those markets are really suffering right now tremendously. And it will be interesting to see what comes out of that. Reid Hoffman put an interesting post out yesterday about, is blitzscaling dead in light of COVID-19? And he basically was arguing, no, in fact, that approach is more important than ever, because in his view, he was saying that it's really your relative market position to your competitors that's the end that decides your ultimate success. Blitzscaling is a competitive strategy more than it is, say, a market entry strategy in his view. And that's kind of where I start to disagree with him a little bit, because I think in the end, the ultimate size of the market you're pursuing has to dictate how much money you put behind these models and how fast you pursue this blitzscaling model. And then where do you share the certain loss? COVID is going to create a lot of economic loss. And how do you share that between investors and founders?
I think what you were saying about European startups being a little bit more resilient, or the venture capital scene a little bit more resilient. Let me indulge you in a couple of numbers, and I wonder what your reaction is here, Kevin. First of all, I thought it was quite interesting to see amongst you venture capitalists, they actually see the term sheet procedure, the due diligence, the signing, since the COVID-19 hit, slowing down. About 44% of the people interviewed by industryventures.com, that's the source here, see it quite slowing down. And actually, if I make the calculation, about 60% really do see a market right now that is getting tougher to raise money, unresponsiveness. That is the first thing. And the second thing is that about 86% of you guys seem to be expecting a recession, and the majority for at least 7 to 12 months or even above that. So from that point of view, if you think about investing into a startup, of course you invest not in the startup only and in the team, but into future profits. I mean, it's not Mother Teresa kind of activity, okay? So you need to know macroeconomically, where is it taking us? Will not only the business model have a chance, but will the market give the business model, the company, a chance?
Exactly.
And the other thing I was looking at, I see it from my own startups. Cash is king. So, the latest figures show me that about 65% of all the startups globally, they only have cash to survive for about 6 months of not having revenue. So cash burn is there. Their ability to bring it down is really, really low. So how do you now position yourself in this kind of environment, Kevin, as a venture capitalist?
Yeah.
To look at your portfolio companies, what happened to the valuations, and what do you think is going to happen to the valuations now in the next few months?
Yep, super. Great questions. First of all, let me come back to some of those numbers you gave there. I'd like to know what the 24% of people, what planet they're living on that aren't expecting a recession coming right now. That's a foregone conclusion at this point.
Love it.
Those people are not watching your show, obviously. You need to get them informed. But and that might be slightly outdated data because it's clear that we're going to have a major recession. There's no doubt about that. The other thing is the 44%, I think, that you said are seeing a slowdown in their fundraising process. That's an incredibly low number to me. It's going to be way higher than that. I had a KPMG thing that I pulled out yesterday that said 84% of European startups are seeing slowdowns. I think yours is global data, so that is interesting. But look, I think everyone's going to be experiencing slowdown in terms, and that's not bad. It's smart for both the founders and for the investors. You're hit with a major exogenous shock, and we need to process that. And still now, no one's sure how serious this is going to become, right? We don't know if this is going to be a 6-month thing. Is it going to be a 2-year thing? You hear from different political figures every minute, different things, right? So I think that makes sense to wait as long as you can to kind of understand what's really changing, because you don't want to put capital. Also, as a founder, people think, okay, the founder wants money for sure, and the investor has to decide, do we want to invest in this or not? No, that's not how it is. The founder also wants to decide, do I want to take more money, have dilution in my ownership right now to put investments into something I'm not sure is going to work? Probably you're going to find a pretty good alignment. Now, when it comes to the existence of my company is severely threatened in the next 3 months if I don't raise capital, then the founders are going to be very aggressive about wanting some form of capital. Maybe it's a bridge loan or whatever it might be.
But they come to you. What are you going to say to them?
Yeah, well, we're having that right now. We are in a very fortunate position that our early stage funds have 80% capital from the European Union, 20% from the Free State of Thuringian. So we have incredibly stable and committed funds from the very beginning. Most venture funds are going to be in that place, but I am a little bit nervous that some limited partners that are backing venture funds, maybe a lot of people don't understand how a venture fund works. The venture fund gets committed capital. They don't actually get capital. If you raise 100 million fund, that doesn't mean you have 100 million on your bank account. It means you have people who have committed to give you as a venture.
Yeah. You have the margin calls then, basically.
Yeah, it's capital calls. And it could be a question for some investors whether this COVID-19 crisis is a force majeure. And whether some limited partners say, we're no longer required. I don't have insights into all the contracts between GPs and LPs in this space, but I do worry a little bit about that for some investors. We're in a good position to be able to continue investing. And I think what we're trying to do right now is to say, look, if you happen to have the bad luck of you're performing good, but you happen, usually venture investors want to plan 12 to 18 months in founders. That's a good time frame that you should be funded for before the next round. You don't want it to be too long. You don't want it to be too short, right? But that's usually broadly in Europe and America accepted as a good time range. If you happen to have bad luck that right now you're coming to the end of your 18 months or you're in month 15 to 18, and even though you've been doing well, that is just really unfortunate. And we don't want to take advantage of the situation in any way, because again, most of these are still pretty early stage for us, at least. So having ultimate success is going to come down to the right motivation structure for the founders. They're the ones who are executing the business on the ground. Most venture investors are not so deeply entwined in the operating business that they're really on the ground making decisions. Some offer more support than others, but it's really the founders that are going to get it done. And I think every venture investor would admit that. So in the end, I think maybe now more than ever, people are going to be employing the venture capital method of valuation, which essentially says, not what is the company worth, it says, what's the right mix of incentives between investor and founder to get this thing to an ultimate success. I came from the publicly traded markets originally, and when people told me about the venture capital method of valuation, I thought they were just crazy. I said, well, that is the silliest, weakest thing I've ever heard. Show me some kind of multiple peer review, DCF. I want a hard figure. As I spent more time in this industry, I realized how unbelievably correct that venture capital method is. And really, early stage, there's not much other way to go.
Yeah, I think this is a very interesting point, because any kind of investor in early stage buys a lot of the goodwill. buys the idea. And we saw it in the latest crisis, where also venture capital was impacted back in 2000, the dot-com bubble. What did that do to valuations? There we had our really, a bubble bursting. And then, of course, financial crisis 2008 and 2009, I think over 1/3 of the venture capital activity just collapsed there and then. So it was a difficult market. But Kevin, let's go back to creation, because COVID from crisis to creation. Okay, so cash is an issue. Employment is a bit of an issue because a lot of these startup companies need to let people go. However, creation, isn't it now the sweetest market for people like you? Because valuations have come down, because the exit outlook is going to be a bit dimmer in a recessive environment. Is it not just a buyer's market where you can buy, I don't want to sound nasty, but on the cheap, really good, innovative, disruptive technologies, for example, going forward?
Yeah, the balance of power has shifted, no doubt, because there was a surplus of capital in the market before, where really it was the founder side that had the balance of power, and now maybe it's shifted because capital has been restricted. It could just be, right now it's artificially restricted, not falsely restricted, but it's not that there's not money there right now. It's there, it's just being withheld. So it might still come back. I think it's not a major fundamental long-term shift. It's more of could prove to just be a short-term thing.
Yeah, no, it's so true what you're saying, Kevin. And I wonder right now, let's zoom it out a little bit, because I'm thinking to myself, why do all the unicorns come out of the US? And why, because of that, is also the West, for example, also Tel Aviv, and China is starting to get more and more that way as well, also the hub for innovation and creation. Because for me to see Europe wanting to be and continue to be competitive on a global scale in terms of what they have to offer in technology, in innovation, in new companies, ideas, and what have you, isn't this one of the main focuses where funds should flow in order, in the long term, really create not only value in companies, but an overall economy and a stronger economy on a global level?
Yeah, definitely. And now, I mean, you're maybe shifting a little into the political realm here, because in Europe, I don't think we're going to see enough of the limited partners come out and say, hey, we want to now put more capital into this asset class of venture capital because times are tricky. I mean, realize now's the chance to do it, like you were kind of saying, from an investment opportunity standpoint. I think their fear will trump their kind of willingness to see this as an opportunity. So that is where you could think about politics coming in and maybe dealing with the market hole. I'm quite familiar with that, because the premise behind BMT's funds, we're in the former eastern part of Germany here, and in my view, generally I believe that capital follows opportunity pretty freely in the world, but I have witnessed here an incredible market hole, I would call it, where you have tremendous technologies, but not a lot of investor interest. And I think it's a mix of things. I think, because East Germany became part of Germany so quickly in the reunification, it kind of got forgotten. A lot of the emerging asset classes in ventures and emerging funds went to Poland, Czech Republic, Romania, Bulgaria, and you had this part of Germany getting not enough attention relative to the incredibly strong technology that it has. So then the question comes, do you need to, as a government, for the state economy, for the country's economy, do you need to step in and fill in these holes? I think to a certain degree you do. In some cases. Right now, I shouldn't be where I am if I didn't believe that. But I do think that, and you're seeing the German government right now just came out with a 2 billion stimulus package for startups. It's taking shape, and there's going to be some different parts of that. It's still, to me, a little unclear how easily accessible all of that will be, but the will is there. That's a good thing. The one thing I would say, though, is politicians really always need to be careful. I say, do what you're doing, make the programs available, but don't make it seem like it's a long-term thing, and don't position yourself as being the savior for the industry, because there is an incredibly insidious kind of resignation that can come through the founder community if you start to think, oh, I'm doing all this work building a company, but actually the real determinant of my success is someone sitting in Berlin or Washington, D.C. or wherever deciding on how much capital actually gets allocated to my venture. I mean, I would say also the onus is on the success stories. To be fair, we have to be fair here, I think. To be fair, Europe has not produced that many of the big successes. So I understand why private investors are still a little reticent to put the huge amounts of capital.
So why is that? Why is that? Let me pick up on that one. So why do you think? I mean, it's been around for a while. Also here, venture capital, PE, etc.
Yeah.
Why not?
Well, like I said, it hasn't proven itself as an asset class in terms of returns. If you stack up European venture capital returns, even U.S. median venture capital returns are pretty weak. The mean is not so bad because you have some really huge outliers, though it's concentrated in a very small handful of funds, by the way. So I think the U.S. venture capital scene is, on a whole, not really any healthier than the European, but it has a few of these superstar funds that have done amazingly well. And there's been some good stuff here. As well. Lakestar in Switzerland, for example, has been involved in a lot of great companies. You're sitting in Switzerland. I used to live in Switzerland.
Neighbor of ours, actually, is a neighbor of ours.
Oh yeah, great. If you look at Germany, for example, and Sweden's had some good successes with Skype and Spotify. There've been a few, but if you look at Germany, even the exits that have been touted as very successful recently, like Sechs Wunderkinder with the Wunderlist, they sold to Microsoft for about $600 million, I believe. And ironically, Microsoft just shut that down this week. But and then
in 26 he's doing very well.
They're doing good.
Lakestar also invested in that one.
They're doing very, very good. I'm talking about ultimate exits where we've had complete sales of the company, because you really need to be careful to differentiate between increasing valuations in successive venture rounds, where generally often the same investors are continuing that investment, and really they're thinking about their total average cost of investment, not just that last round when they're pricing that final round. There's a little bit of sometimes Germany is less susceptible to this because German accounting rules don't let you mark up your book above your investment values. In the US, you can actually mark up your own book with an investment round, and then you look like your first investment looks like it's brilliant, even though it was just you marking it up. That's an interesting
massaging the numbers, bit of window dressing in the VC.
Yeah, exactly. That happens a lot in this business. The illiquidity allows for that. But in Europe, you have less of that, which I think is healthy in general. But they're just. Salonis is an interesting one as well here. There are some now that are doing well, but in terms of actual sales of the company, you had Relayer last year to Munich Re, and that was 450 million. You had Sechs Wunderkinder, 600 million. You haven't seen a lot of the billion plus exits. You've seen billion plus valuations as further financing rounds have come, but you haven't yet seen that. I think it's going to come. In 26 seems like they're performing phenomenally well, and I think that valuation is probably justified. But, I think it will take seeing some of those final exits before the market really puts a lot of private capital at work. And it can become a self-fulfilling prophecy, because if you don't have that huge amount of capital, even you look at all the big financing rounds, in 26 and Salonis and a lot of the other bigger rounds that have happened, Get Your Guide, Flixbus, all these big rounds that have happened here in Germany, a lot of them that are over 100 million, the majority of the capital is coming from outside of Germany.
What is quite comforting, to just put a positive note on what you were saying. Yes, venture capital here in Europe is still small, but actually the growth dynamic is a multiple of that what it is in a mature market like the US.
Let's come back to that, because I feel like I'm coming off here way too negative on the European venture capital scene. I want to just really be clear. I think we just have to understand what we're good at and what we're not. And if we execute on that, I think it's going to be a really attractive asset class over the coming 10 years, because it has matured. I recognize that even here in our region. If you look at the founders 15 years ago versus the founders now, things have really progressed in terms of understanding global markets. This is probably true around the world, but I think here even more, people are becoming more internationalized, global thinking. When they've done their business school everywhere, you're getting more business founders as well. Historically here, we've had a lot of engineer founders that they're the developers of the tech, and they become CEO, they found, and that can be dangerous sometimes if you're trying to grow the business in a very quick way, or you have to act with more business focus as opposed to tech focus. And certainly when you're building a business, at some point you do.
Yeah.
And that was a point I touched on earlier. I think you're seeing more of that now in Europe. The acceptance of founders saying, you know what, I don't have to be CEO. I don't have to control this company like it's my baby all the way to ultimate success. In fact, my chances of ultimate success are better if I do what I'm good at and I bring in other people that are good at what they need to do to make the company successful. That's happening. US was better at that in the past. I think they're ultimate success was valued higher than control. And I think that was for a while here not the case, but that's changing. And really, if you talk about the delta versus where the US venture capital industry is now, where it's going to be in 10 years, and where the European is now, and where it's going to be in 10 years, I think that the rate of improvement and the improvement on returns, I would definitely be betting on Europe.
Yes, yeah, well, it's a bit of a Nike swoosh there,
Exactly.
rather than something else. Okay, to wrap up our conversation, Kevin, I would really like to give a little bit of a takeaway and your wisdom on what you would say to somebody as a venture capitalist going forward and also dealing with a post-COVID-19 world. And also, what would you say to founders, creators, entrepreneurs that are having their startup or thinking about creating a startup? What would you say are the three main learnings for both of these categories, which of course should be a symbiotic get together eventually?
Well, it's a good time to invest and a good time to found, as you said. If you look back at the 2008, 2009 crisis, a lot of the success stories from today, Uber, Airbnb, Slack, I believe as well, all founded in that time period and have gone to huge success. You come out of these periods with less competition. You're hardened because you started the business in a tough environment. I think that's actually very beneficial. So, accept the environment as it is, learn from it, and develop strength and resilience based on that. That would be for both investors and founders. And I think in this time of crisis, more than ever, we like to promote full trust between founder and investor from day one anyway. But I think now more than ever, discussing the various scenarios, how are you going to react if our sales fall 25%? When do we decide we're on the wrong path? When do we decide it's just a short-term blip in our overall good trajectory? Having those honest and upfront conversations between investor and founder are going to be incredibly important right now. And we've been seeking out conversations with all of our founders. The last thing you want right now is a vacuum. So seek communication with your investors if you're a founder, with your founders if you're an investor. Right now, more than ever, you don't want to have this kind of vacuum where people are wondering, does my investors, are they suffering right now? Are they going to back me in this round still? You don't want founders worried about that. Assuming you want to back them, you need to communicate that. And likewise, on the other side. And the other thing I was say, venture capital and founding as an asset class and as an endeavor is a long-term game. It's a 7 to 15 year endeavor when you start a company, but to ultimate success generally, right? It's very rare that you have that great exit after year 1 or 2. It happens, but it's rare. And because of that, I think people can, for the most part, look through this. COVID is a very acute and serious situation, no doubt about it, but I find it hard to believe it's going to dominate the next 7 to 15 years. And I think humanity is going to prevail on this one. So I would say just essentially understand what its impact is, understand how you can kind of shell up for a while. If you need to use some of the Kurzarbeit in Germany, it's called worker protection programs, things like that, to save costs and liquidity, do it. But don't let yourself get too negative based on the current environment. Think about where your business is going to be in 3 to 10 years anyway, and keep going down that path.
Yeah, and I like that, Kevin. And I wonder, if you look at the sectors, we're talking about the sharing economy, perhaps being in a COVID-19 environment, a little bit more difficult as a business to fly. Where would you go the next 10 to 15 years in terms of sectors or technologies? Where do you think the most money is going to flow because there's the most chance of having success?
Yeah. Well, I would pull out a couple. I think let's put the European venture investor lens here on and say, I think we've kind of missed the move on like e-commerce platforms and stuff like that. I think, Zalando's doing okay and things like that, but I don't think that we're going to emerge as a champion there. So let's go to the next level of technology. I think big data and artificial intelligence is going to be a space where the European technology base is extremely well suited for that. And I think you also don't have to necessarily have such a B2C facing company for that to be incredibly valuable. So that's one huge category. I'm not personally sold yet on blockchain and decentralized ledger technology in terms of its use cases, but it is an area, throw crypto in there as well. It's an area that is still in its infancy. And that means if you can figure it out, there's no global players that are really dominating that, maybe Bitcoin in crypto, but even not really. There's lots of other cryptocurrencies.
Yeah, you and I, we have to talk about Bitcoin.
Okay.
Yeah, go on that one.
but that's an interesting new category. Autonomous driving We just made an investment actually last week in a company that's doing a combination of LiDAR and other imaging techniques for drones and for air taxis. And actually, in the air mobility world, is a little bit less complex than the driving mobility world, where you have kids running across the street and stop signs and all that stuff. So you can actually bring your technology to market faster there, and then transport it down to the other level. A little bit off track there, but then life sciences, to me, it's been one of the best performing sectors for like the last 10 years. If you look at the publicly traded markets, with a few dips in there, but over the 10-year period, definitely the best performing sector. And there's reason for that. We're living in a more globally competitive world, and that means kind of software or short-term opportunity-based business models might work for a while, but they're less valuable than the ones that can be protected long-term, like life sciences can through patent protection, things like that. So I think that's a really attractive space. We have 40% of our portfolios in life sciences. We happen to have here in Jena a really exciting life sciences cluster here in Germany. That's part of what's driving that. But I think I'm super happy that is a focus for us, because I think it's a wonderful space to be in. I personally was also a life science investor for 12 years of my career before coming over.
Kevin Reeder, thank you so much for all your insight. And good luck to yourself, to your portfolio, and of course all the startup companies. Hang in there.
Thank you for having me on the show. I really like what you're doing with Mentoring TV. It's great.
Thank you so much.